Canada has always sold itself as the European cousin of the United States. A country that is just as rich, but safer, fairer and more stable. But as we head into 2026, that dream has become a nightmare. Living standards are plummeting, the youth are fleeing, and the economy is being hollowed out by a crisis that makes the Great Depression look mild. So today, we're going to explain why Canada is dying, why its housing bubble has become a national security threat, and why the US might be preparing to foreclose on the country. My name is Guy, and you're watching Coin Bureau Finance. First up though, we need to make one thing clear. Nothing in this video is financial advice. This is educational content to help explain the dire state of Canada. And if you want more deep dives like this, make sure you're subscribed, drop a like and flick that notification bell so you don't miss the next one. Now, to understand how Canada got here, you have to stop thinking of it as a country and start thinking of it as a business. Because right now, Canada is a failing enterprise. Think of it as a legacy brand, like a 3-star hotel still charging 5-star prices because it's living off a reputation built 30 years ago. You book it because you remember the name. You remember it being fancy. But when you check in, the pool is closed, the room service is overpriced, and the staff are overwhelmed. That's the Canadian economy in a nutshell today. It's a high-tax, high-cost jurisdiction that no longer delivers the premium services or high wages that once justified the bill. And the customers, in this case Canadian citizens and foreign investors, are starting to check out. Now, the root cause of this isn't bad luck. It's a productivity crisis that's been festering for decades. While the United States spent the last 10 years investing heavily in artificial intelligence, machinery and industrial capacity, Canada poured its capital into one thing: housing. And this isn't an exaggeration. The data shows business investment per worker in Canada has been collapsing, even as it surged in the US. In fact, American workers are now nearly 30% more productive than their Canadian counterparts. Why? Well, not because Canadians are lazy, but because they haven't been given the tools. You can't build a modern economy when your capital is tied up in drywall and land speculation instead of software, research and machinery. But the problem runs deeper than investment alone. It's also structural. Canada's economy is choked by what can only be described as state-protected oligopolies. Now, in a healthy market, competition drives prices down and quality up. In Canada, key sectors like banking, telecommunications and groceries operate as protected cartels. Take telecoms, for instance. Canadians pay some of the highest mobile data prices in the world, roughly 7 times more than Australians and orders of magnitude more than consumers in Finland. Or look at groceries, where just a handful of firms control close to 80% of the market, effectively price gouging families on basic necessities. And this lack of competition acts like a hidden tax. You earn less because productivity is low, and you pay more because competition is illegal. It's a double squeeze that's suffocating the middle class. And this brings us to the inevitable result, the brain drain. Because if you're a young engineer, doctor or entrepreneur, the maths simply doesn't add up in Canada anymore. You can move south of the border, earn double the salary in US dollars, pay lower taxes, and buy a house for less than the price of a Toronto condo. And that's exactly what's happening. Emigration from Canada to the US has surged by over 70% in the last decade. And it's not just about how many people are leaving, it's who is leaving. The people fleeing are the ones Canada can least afford to lose: high earners, risk takers and innovators. Because a country that punishes success to subsidize stagnation is not a place you build a future. And that creates a feedback loop. As the tax base shrinks, the government squeezes the remaining population harder to fund ballooning deficits, which only pushes more people out the door. So, for the last 15 years, Canada hasn't been fueling its economic engine, it's been pouring all its fuel onto a bonfire called the housing market. Now, to put the scale of this into perspective, in the United States, real estate accounts for roughly 20% of total capital investment. In Canada, that figure is closer to 40%. For a while, this looked like genius. Homeowners felt richer as paper net worths exploded. Politicians took victory laps. But now the bill has come due, and the maths is terrifying. Let's take a look at the numbers. To buy the average home in Canada today, a household needs an annual income of roughly $170,000. In Vancouver, that jumps to an eye-watering $360,000. Now, the problem being that the median household income sits at around $70,000. In other words, the Canadian dream of homeownership hasn't drifted out of reach, it's been launched into orbit. And what do you get for that money? Well, in Austin, Texas, $2 million buys you a mansion. In Vancouver, it gets you a tear-down shack that looks like it should have been condemned in the 1990s. To make matters worse, unlike in the US, where buyers can lock in a 30-year fixed-rate mortgage and sleep at night, Canada runs on 5-year terms and variable rates. So, when interest rates spiked to fight inflation, millions of Canadians saw their mortgage payments double or even triple over the years. But if locals can't afford to buy and the economy is stagnating, what's keeping prices so high? Well, this brings us to the dark underbelly of the so-called Canadian miracle, snow washing. Canada has a global reputation for being polite and law-abiding. But in the financial underworld, it's known as one of the easiest places on earth to launder money. A government-commissioned report in British Columbia blew the lid off this, revealing that billions of dollars in black market money have been funneled through Canadian real estate every year. Anonymous shell companies, often with no clear beneficial owner, have been snapping up properties in Toronto and Vancouver like it's a game of Monopoly. So you're not just competing with your neighbour for a home, you're also competing with global capital flight and organised money laundering. That said, though, dirty money is only half the story. The other half is brutally simple economics, supply and demand. While governments have tightened regulations on building new homes, they've simultaneously blasted demand into the stratosphere. Since 2016, Canada has admitted nearly 3 million new immigrants, a population increase roughly the size of a small country, all funneled into the same 3 major cities at the same time. And when you combine a supply-constrained market with a demand shock of that magnitude, you don't get growth, you get a crisis. And before we move on, if you want to take more control of your financial future, one simple step is staying informed. And you can do that by signing up for our weekly newsletter. While you're there, check out the finance-related deals we've put together exclusively for Coin Bureau viewers. Just click the link in the description below or scan the QR code on screen. It's completely free and the deals include exclusive bonuses, discounts and promotions. Now, before anyone reaches for the pitchforks, let's be clear. Immigration, when done right, is a superpower. It brings in talent, capital and younger workers to offset an aging population. But what's happening in Canada right now is something very different, what economists call the population trap. Here's how it works. Canada has built an entire economic model that relies on endless population growth to prop up GDP. The government can't afford to stop the inflow because the economy would contract. But it also can't afford to keep it going because the infrastructure, hospitals, roads, housing, etc., is collapsing under the strain. And the real damage shows up in the productivity data. When you flood an economy with people but don't increase business investment, you get what economists call capital dilution. You're spreading the same stock of factories, machinery and software across more and more workers. The result is that everyone gets poorer, per capita output stagnates, wages are suppressed and living standards drift steadily downwards. And the promise of attracting highly skilled workers hasn't played out either. The narrative was that Canada needed engineers and doctors. The reality is that much of the inflow has gone into sectors where labour supply was already abundant. Corporations quickly realised they could bypass the domestic labour market entirely by exploiting the temporary foreign worker programme and student visa loopholes. That's given rise to an entire underground industry known as Labour Market Impact Assessment, or LMIA fraud, where consultants and business owners sell job offers to desperate foreigners. Why? Because that job is their ticket to permanent residency. Businesses post ghost listings on obscure websites to prove they can't find a Canadian, then quietly hire the foreign worker who paid the kickback. The business gets cheap labour, the consultant pockets a fat fee, and the Canadian teenager looking for a summer job gets told there are no vacancies. The United Nations has gone as far as to flag Canada's temporary foreign worker system as a breeding ground for modern forms of slavery, and it's hard to argue with that assessment. We're now seeing international students living in vans or crammed 10 to a basement. Why? Because the colleges they attend are often nothing more than diploma mills located in strip malls above a pizza shop. These institutions aren't designed to educate, they're designed to print work visas. Students arrive, realise the education is a sham, and are forced into the gig economy just to survive, driving down wages at the bottom end while pushing rents higher in the poorest neighbourhoods. The result is that immigrants are being exploited, the local youth are being priced out of entry-level jobs, and the only real winners are intermediaries, landlords, and corporations. And when you step back, this becomes even more worrying. Historically, one of the most reliable predicators of civil unrest is a surplus of young men with no economic prospects. In Canada today, there's a statistically significant surplus of roughly 250,000 men in the 20 to 29 age bracket compared to women. That leaves a generation who can't find stable work, can't afford housing, can't start families, and see no path to matching the living standards of their parents. That isn't a recipe for a recession, it's a recipe for a revolution. And as the social fabric phrase, political leadership has been busy managing the optics instead of the crisis itself. Which brings us to the people who were supposed to fix this mess and why they may be making it worse. By late 2024, the writing was on the wall. Justin Trudeau's brand had become toxic and the country was desperate for a change in management. Enter Mark Carney. The former central banker was sold as the adult in the room, the technocrat who would restore credibility to Ottawa and rein in the deficit. But despite promises of fiscal restraint, the Carney administration is now on track to run a deficit in the range of $70 to $90 billion. That would be the second largest deficit in Canadian history, surpassed only by emergency pandemic spending. It's this level of mismanagement that's led economists to whisper a name that terrifies anyone with a memory of history: Argentina. A century ago, Argentina was among the richest countries on earth, the Canada of the South. But decades of bad policy, protectionism, and debt turned it into a serial defaulter, lurching from crisis to crisis. Canada is now speedrunning that same trajectory. And the government knows it. In a leaked report earlier this year, federal police warned of potential civil unrest once the public fully realises that the next generation will be permanently poorer than their parents. And if the money runs out, the country itself could begin to fracture. Canadian Confederation is held together by equalisation payments, massive transfers from richer provinces like Alberta to poorer ones like Quebec. But what happens when the rich provinces go broke, or simply refuse to keep paying? We're already seeing renewed calls for separation in both Alberta and Quebec. And if the federal government loses its ability to keep the provinces aligned, the map of North America could look very different in the decades ahead. But Canada's biggest problem may not even be in Ottawa. It's the shark circling in Washington, D.C. A weak, divided country is a vulnerable one. And under the new US administration, the era of the friendly neighbour is clearly ending. We're seeing the activation of what the US national security strategy calls the Trump corollary, a blunt message that the Western Hemisphere belongs to the United States and that non-hemispheric competitors are not welcome. To enforce that, Washington has taken a sledgehammer to the trading relationship. The tariffs imposed in 2025 weren't just a trade dispute, they were economic warfare. Because when 75% of your exports go to one customer and that customer decides to squeeze you, you don't have a negotiation, you have a hostage situation. And it only gets worse. The rhetoric coming out of the White House has shifted from protectionism to something that sounds suspiciously like annexation. The jokes about Canada becoming the 51st state were easy to laugh off at first. But when you look at the scale of the economic pressure being applied, it stops being funny. Because while the US may not want Canada's broken economy, it certainly wants its assets. Canada sits on some of the world's largest reserves of critical minerals: lithium, cobalt, graphite, and rare earths, the oil of the 21st century. The US is desperate to secure these supply chains to reduce its dependence on China. And when Washington looks north and sees a country with the resources but not the political will to extract them, Canada starts to look less like an ally and more like a liability. Which makes the ultimatum painfully clear. Either Canada gets its act together, secures its borders and integrates its resources into the US industrial base, or the US will effectively do it for them. So, looking at the evidence, it's easy to conclude that Canada is on track to become a vassal of the United States, or worse, a fractured collection of provinces fighting over scraps. But it doesn't have to end that way. Because, for all the doom and gloom, Canada still holds cards that most countries would kill for. It has the world's fourth largest oil reserves. It has uranium to fuel the nuclear renaissance. It has the critical minerals needed for the AI and EV revolutions. And it has a highly educated population that's currently being wasted on Uber driving and real estate speculation. So the path out of this mess isn't a mystery. It just requires the political will to do three things Ottawa has avoided for over a decade. First, unlock the energy. Canada is sitting on trillions of cubic feet of natural gas that Europe and Asia are desperate to buy. But thanks to red tape and a refusal to build pipelines to the coast, that gas is effectively stranded. So, if Canada fast-tracked its liquid natural gas export terminals, it could turn its energy sector into a cash machine. The world needs energy security, and Canada is one of the very few stable democracies capable of supplying it at scale. Second, smash the oligopolies. Canada's cost of living crisis is largely artificial. It's the product of government-protected cartels in banking, telecommunications, and groceries. If Ottawa opened these markets to real competition, letting American or European carriers compete with Rogers and Bell, or letting Aldi compete with Loblaws, prices would fall and productivity would rise. You cannot have a dynamic economy when your largest companies are effectively illegal to compete with. And third, the grand bargain. This is the most painful option, but it may be the only way to survive the Trump administration. Canada needs to use its critical minerals as leverage. The US is deeply concerned about China's control over lithium and cobalt supply chains, and Canada has exactly those resources. The play here is strategic integration. Canada guarantees the US secure preferential access to these minerals and removes Chinese state-owned miners. In return, Washington lifts tariffs and commits capital to build processing facilities in Canada, not Texas. It's a trade-off of sovereignty for survival. And in 2026, survival may be the only game in town. If Canada can make this pivot away from a real estate casino and towards an industrial powerhouse, it won't just survive. It could thrive as the energy and technology arsenal of the Western Hemisphere. But if it refuses, if it keeps doubling down on housing bubbles, debt, and managed decline, then the 51st state line won't be a threat. It'll be a foreclosure. And now we want to hear from you. Is Canada too far gone to fix, or can a new strategy turn the ship before it hits the iceberg? Let us know your thoughts in the comments below. And if you want a deeper look at just how bad the housing crisis could get, you can watch our full breakdown right here. As always, thanks for watching, and we'll see you again before you know it. This is Guy, signing off.